Dixon's acquisition of this 6,000 crore revenue company, a quick deep dive. So Dixon Technologies is the poster boy of electronics manufacturing in India, and it is the largest listed company in that space. So the company that clocked rupees 2,500 crores in revenue at the time of its IPO is now heading towards 17 to 18,000 crores of revenue this year, almost 7x in 7 years. So it IPO'd at 1,766 per share of rupees 10, and now it is quoting at 7,850 per share of rupees 2. So if you convert into rupees 10, it is almost 39,000 rupees per share, or 20 times return since its IPO. And now if we break down this total revenue of 17 to 18,000 crores, almost 60 to 65% of it comes from mobile phone manufacturing, or rather assembly. And if you look at other verticals also, Dixon is there in LED lighting, LED television, refrigerators, washing machines, telecommunication equipments, wearable manufacturing, and the latest being the assembly of laptops for Acer and Lenovo. So these are all divisions where Dixon has got scale, but then the mobile phone as a category is so large that it has just overshadowed other categories, that's all. Then coming to the acquisition of Ismartu India, this is a company that owns brands such as itel, Infinix, and Techno, and it has 3 manufacturing plants in Noida. This is also a place where Dixon has most of its mobile phone manufacturing facilities. And this acquisition is happening in a few tranches, like it will be completed by FY27 only. So on signing up of the deal, Dixon will be paying somewhere around 238 crores, and then to acquire almost 50 to 56% stake, that Dixon will be paying another 2,000 to 2,500 crores over the next 2 years, with a condition that the company will make 200 crores profit after tax in FY26. So the acquisition is being planned in such a way that the company will be valued at 20 times FY26 PAT, or at 4,000 crores, and Dixon will acquire anywhere around 51 to 56% of that company. And that company is expected to, Ismartu India is expected to do somewhere around 7,000, 8,000 crores of revenue, maybe to that level in FY26. And this entire acquisition is expected to be completed only in FY27. So by that time, I think this will give a big leg up to Dixon's revenue growth, because Dixon also has 2 years of runway for its own growth, and it may be pushing it to a very big league, especially in the area of mobile phones. To put in numbers, Dixon is already having a capacity of 70 million mobile phones, 70 million mobile phones, and that and if we compare with the all India demand for mobile phones, it is just 220 million. Dixon does exports as well. And currently Dixon is manufacturing for Samsung, Motorola, and Nokia, and it has also recently signed up with Xiaomi as well as BBK Electronics, that owns brands such as Oppo, Vivo, Realme, and OnePlus. So it is already there with all the major players in the Android category as well. And by the way, all these things are triggered by one thing. First, it was the crackdown on Chinese companies, and then it was followed by the PLI, and then government's thrust on domestic manufacturing. And Dixon happened to be at the right place at the right time to grab a major chunk of this opportunity. Now let us get into the financials of this acquisition. So it is happening at 20 times earnings for the target company, Ismartu India, versus Dixon's own valuation of just over 100 times, or more precisely close to 120 times at this point of time. So, do Dixon have money to pay for this acquisition? The answer is no, because Dixon has been reinvesting its entire cash flow back into business to fund its growth, because it has grown 7x in the last 7 years, and it is growing, and it has also more capex left. So how can Dixon fund this acquisition? Interestingly, if Dixon can dilute just 5% of its equity at current valuation, then it can garner the entire amount that is needed for this acquisition. And this acquisition is going to happen only in 2 years. And maybe this acquisition can add close to 30% of EPS to Dixon at that point of time. So a 5% dilution adding 30% to EPS, and that is quite interesting, and that appears to be the case at this point of time. And this acquisition model has been used by many listed companies in the past to create value to shareholders. Now, one obvious question that may be there in investors' mind is that why that company is selling out to Dixon at 20 times earnings, and why can't it go for IPO then? Perhaps it is a single product, single client company, and so even if it goes for an IPO, the valuation that it may fetch may have limitations. That may be the reason. But at the same time, important thing to understand is that Dixon's rich market valuation is due to three important factors. One, scarcity premium in the listed space due to its huge lead. Second, its execution track record, where it has grown 7x in last 7 years, and it is still net long-term debt-free, and it is generating close to 30% ROCE. So, if it utilizes its current market valuation to fund this acquisition, then it can retain these key attributes. And third is electronics manufacturing is a business of scale actually, and Dixon scores very big on this count. So these are the three reasons why Dixon is fetching premium valuation in the market at this point of time, and it needs to preserve these key attributes so that market continues to give the rich valuation to it. And till now, kudos to the founder and management team for grabbing the opportunity as well as dreaming big. Thanks for watching.
The speaker holds this stock as a part of his personal portfolio. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.